if you go back in last 20, 30 years, it's really one of the most impressive financial innovations we've seen, right, come out in the financial services industry. And the reason behind that, because it was able to provide investors and advisors with a tool that can be very targeted, that can be cheap, that is transparent because you're seeing holdings and movements on a daily basis. And there's very liquid. Before, we used to have mutual funds, which are the same concept in a way, but mutual funds trade once a day at 4 p.m. at close, where you match orders and has hefty fees. Right, 1.5, 1.6% sometimes. If you want to get out early before 2 years, they charge you an additional 5%, or when you get in, they charge you 5%. So ETFs simplified all that. It allowed investors to have access to these tools, and also allowed issuers or asset managers to provide investors with very targeted allocations, like EVs, like robotics. And now the biggest trend is weight loss, with the weight loss ETF. So you can just create an ETF out of anything you want. You just create a bunch of companies, and you put them in a fund called an ETF. So it's an exchange-traded fund. So basically, the ETF married the concept of a mutual fund and a stock. And then the offspring is an ETF. That's why we believe it's a huge investment innovation in the financial services industry.
So today we have the pleasure of hosting Anthony Sassine. Anthony is the head of MENA and senior investment strategist at KraneShares. KraneShares is an investment management firm that specializes in China-focused exchange-traded funds, providing innovative solutions to global investors seeking exposure to China's growth and emerging market opportunities. In addition to managing the firm's business in MENA, Anthony is also responsible for researching China's capital markets and innovation sectors, including clean technology and future mobility, and advising clients on asset allocation, thematic investing, and co-managing ETF model portfolios. Anthony has held a CFA charter since 2012 and has extensive experience in financial research, strategy, and investment management. Anthony, welcome to the show.
Thank you for having me.
Yeah, so first, I think, tell us, who is Anthony on a personal level?
Thank you. It's a pleasure to be with you, Bilal. Anthony, so I'm originally from Lebanon, and grew up in Lebanon, and then when at 18 years old, moved to the U.S. To go to school. And after doing my bachelor's degree, I went into investments. I've always wanted to work in finance. And for some reason, when I was 13, 14, I thought I would be a stockbroker, because I used to see them on the news, right, doing this and that. It seemed like fun. But once you really go on the floor at New York Stock Exchange, it's not something you want to do. Plus now, it's all automated, so dodged that bullet. But went into finance, into investments specifically. And after I graduated, I started working at an investment consulting firm in Boston. Basically helping institutional clients, endowments, foundations, high net worth, kind of manage their money and meet their obligations. So that was an interesting period because halfway we hit the global financial crisis. And that was a really big eye-opener for me, like on crisis, how destructive it could be for wealth. And also how stress-inducing event could be for people who are investing in the market, even for organizations. But through that process, I think we all learned a lot, especially myself, seeing institutional clients kind of adjusting their portfolios and going into products that were fit for that period. And everybody, the message from that crisis back in the days was, keep investing, keep your dollar cost averaging, keep doing what you're doing. Hopefully you did not take too much risk before then. And, sure enough, 2-3 years later, we came back from that crisis, and a couple of years after, we were in the green again. So whoever followed that advice, it was really good advice, So after that, I moved into the buy side, focusing on emerging markets in China. And immediately I was really struck by the massive potential of China. How big the economy was, how productive the people are, innovation, and this long-term potential of China, right? If you look at China back in the days, it's probably, you want to compare it to the US back in the 1960s and 70s, right? Where where if you see it in the 80s, 90s, and 2000s, it's still until today, it has seen massive growth, massive expansion.
Yeah.
So really wanted to kind of specialize in China. So I did my master's degree with NYU and Hong Kong University of Science and Technology, because I wanted to spend some time in China and Hong Kong, and I did that over the period of 2 years. Learn more about the culture, tried to learn the language, but after 2 months, it's very difficult language, very tonal. And then after that, I started working at KraneShares, which is an investment firm, as you mentioned, specialized in China initially, right? KWeb is one of our biggest funds. Today is the biggest China fund outside of China. So that was the right place for me, working as a senior investment strategist. A couple of years into that, around 2020 or 2021, after COVID, started looking at the Middle East, right, at the growth that is happening here. And we kind of came to the region and spoke with a lot of the exchanges, regulators, family offices, and, decided that we need to expand more here. We need to become, more engaged in the local investment community. So we set out to actually launch funds here and be more involved directly in the market, not just opening up an office or coming in and out, but actually moving here and then setting up funds and launching on Dubai Stock Exchange or the Abu-Dhabi Stock Exchange and Tadawul as well. And it's been a great 4 years, and so now we continue that process here. I actually moved to the region with my family. We literally got here yesterday.
Oh, congrats!
And
we're lucky to have you.
Yeah, thank you. Lucky to have you.
No, I think it's interesting how you caught on to trends of China early and the Middle East also 4 years ago, where you're seeing now everyone coming in, and you caught that trend early as well. So it's nice to see that you have now your roots here involved with us as well.
Absolutely.
You spoke about the global financial crisis. So in regards to the global financial crisis, coming out of that, through that experience of seeing the stress and seeing the investor behavior or seeing the industry behavior, the organizational behavior, coming out of that, and now when you reflect on that today, what's the biggest learning experience you have from that time?
Yeah, no, dollar cost averaging. That's the biggest, learning experience from that is the markets are going to go up and down, and sometimes they're going to go down way more than you expect. It's going to be a little scary. Volatility is going to be high. Headlines are going to be very negative, but at the end of the day, these companies, they don't just disappear overnight, right? They're backed by major businesses, by major cash flows, by big trends in the economy that don't just disappear. So you just have to try to block all the noise, work with your advisor, very important to work with your advisor, be diversified, and dollar cost average into it. And if you keep doing that, I think when you get out of it, you'll be stronger, you have more money. Your wealth would be bigger.
Yeah, definitely. You see that trend a lot where it's so easy where markets are going up, people to invest because the news is always so positive. But you see just last week how when volatility increased and the market dipped for a week, and it's not 2008 levels, right? And you already see types of behaviors that come out of that. But I like the idea of dollar cost averaging, because you're not saying I'm choosing when to enter the market, but instead you're saying, no, regardless, I'm entering the market. And I think that ties well into China. So we've seen with a lot of investors that were bullish on China who had invested, they had done very well. But over the past years, you've seen that the American markets and other markets have continued to go up while China has stagnated. So what do you feel like the approach is on that versus a diversified investment in terms of timing and dollar cost averaging, or how do you see exposure towards China in these times?
Yeah, no, definitely. I mean, market timing is very hard. There are very few people that can do that successfully and continuously. Probably very, very limited number that can do it continuously successfully, right? And so that's why dollar cost averaging is very important. Being diversified is very important. And, I just have to say that the VIX this week was actually, the spike in the VIX was really like what we've seen in 2008. Probably it's the second largest spike we saw.
And so for everyone to know, VIX is the volatility indicator.
Yes, indicator. Yeah. So that
So
was
it's spiked up, which means there was more volatility
in the
than there's
market.
been in a while.
Yeah, and it's the second largest on record.
Yeah.
The biggest was 2008. So it was kind of a scary week. But if you're diversified, I think you should be good. And the thing is to look long term, right? And to have diversified portfolio allocation. And that's depending on your risk tolerance and what you choose with your advisor. But basically, you need to have exposure spread across the globe, right? So in the U.S., a lot of people have home bias. So you see, like, especially now after the market's been so strong for last 15 years, you see allocation in the U.S. up to 60-70% of the portfolio. I mean, MSCI ACWI today is at the U.S. is the highest it's been ever, right? So you tend to overlook other markets, right? Like Europe, like Japan, like China, and these are very productive markets. They go through cycles, and maybe in the past 15 years that adage did not work as much for specific reasons coming out of the 2008 crisis, but then you saw all the stimulus, all the liquidity that went into the market that kind of helped the market go up in a way that is not really traditional. But also the question is on the outside, how is the exit going to be, right? And today, some of this volatility we're seeing is because of that behavior from the Fed for the past 15 years. So we have to be careful with that. Valuations all-time high. So now what you do is you want to look at markets that are not as expensive and still have growth. And we saw Japan earlier this year had a good run too. So if you were diversified, you would have caught some of that. India has been very impressive for the past 3 years. China, on the other hand, have been in a little bit of a slump over the past 2 years. And I think this is not an economic slump per se in a way that China's not growing anymore or innovation disappeared or people start being productive. No, that's still continuing, right? But then you've had a pause basically because of COVID once, and then coming out of that, it was a very tough period for China during COVID, and then also some regulatory changes from the government, right? President Xi seemed to be moving China a little bit more to the left. I don't think people think he's going to go all the way left, but he doesn't have that ability. He's just moving it slightly to the left with common prosperity and some of these regulations. And this period of adjustment have kind of impacted consumer sentiment and investor sentiment. And that's why we see China today, not doing as well, but still very cheap and very low positioning. And, it's going to go through a cycle. And at some point, that cycle is going to end and China's going to come back. And so that's why you better be diversified and have exposure across the globe.
I think that resonates well with me as well, because what we've seen is it's not just a home country bias in the U.S. where U.S. investors just invest in U.S. stocks, S&P 500, but because a lot of the investment media that we have is so U.S. focused, where you end up having investors even in the UAE and in the region, and when they think about diversification, they think about the S&P 500. So immediately when you talk about equities, people think about the S&P 500 rather than thinking about what you said, MSCI ACWI, which is an all-country index.
Yeah.
People immediately think about the largest 500 companies in the U.S. and think that's proper diversification. Very important to note, adding international. When you look internationally outside the U.S., how would one go about understanding how much allocations to put in different regions? Would you follow how the world looks like from a market cap weighting, which is the largest companies, where are they based? Or how would you go about that, of course with an advisor, but just general logic in terms of allocation?
Yeah, definitely. So we work with a lot of advisors and clients, right, on this specific question. It's not like why China or why emerging market, but also how much. It's a big question. And, so basically what we advise is, there's two ways you can do this. It's either first you need to be benchmarked to something, right? And usually people pick the MSCI ACWI. So if you go with the MSCI ACWI, a regular benchmark market cap, that could be a good indicator. But also there are some setbacks that you don't actually take into consideration within that index, right? So basically, the MSCI ACWI, because of MSCI is so massive, it has to include all the companies within a country or a region that are liquid enough. They have some rules and constraints that they have to abide by. For instance, so if MSCI can only include shares outstanding, that are, that are trading, right? So if you have a company that is privately owned, 20% of it is privately owned and 80% floating, right? So MSCI would take into consideration the 80%. So basically, if you have
So that wouldn't be in the representation of the index.
right. So basically, let's say BYD, which is the biggest Chinese auto company, it's 50% owned by the management, right, and 50% floating. The total market cap of the company is actually 130, 140 billion, but based according to MSCI, it's only 60 billion. So basically, you take that across all regions and all companies, and companies in emerging markets tend to be more owned by management versus the US. So that immediately brings the representation of emerging markets and Chinese companies very low, right, in terms of weight. So today, you look at emerging markets and MSCI ACWI, it's only 11%. China, 3%, right? China is the second biggest economy in the world. Second biggest market is only 3% of the all-country index. That doesn't make sense, right? But you can go that route. And if you do it today specifically, as I mentioned, the US is going to be 70% of your portfolio. And US, by everybody's account, is really 1.5 standard deviation above historical average, right? So you would be putting 70% of your money in one of the most expensive asset classes today. The way we like to look at it is from an MSCI ACWI GDP weighted, right? So basically, we look at the GDP contribution of every country, right, and kind of estimate to see how the world look like from that perspective, right, and then allocate potentially based on that, or maybe make some adjustment. So if you look at China, China's GDP contribution to the world is 18 to 20%, right? So not 3%, 18 to 20.
It's a big difference.
Big difference. And emerging markets goes from 11 to 44%, right? That's even a bigger, wider margin, right? So basically, you want to land somewhere in the middle, okay? But the biggest misconception here is when you tell someone you should take your allocation to China or emerging markets from 311 to 1844, they look at you like you have 10 heads. Like, are you serious? I'm like, yeah. You can be somewhere in the middle. It's like, my standard deviation is going to go through the roof. And what people or advisor or client forget to see here is the power of correlation. Because these markets are not very correlated, especially when you look at China, when you actually put all these countries with the US in a portfolio, the actual standard deviation could be as much, maybe 1% higher, and then sometimes lower, So basically, having a higher allocation to these overlooked markets is good from a valuation standpoint today specifically. These are the markets that are growing the most in the world, right? We've seen a little bit of an anomaly over the past few years with the US growing 4 or 5% coming out of COVID. And also, you get the power of correlation, which actually diversify your portfolio and could lower your standard deviation. So MSCI GDP, MSCI ACWI GDP weighted is one way to look at it. MSCI ACWI is another way to look at it. We also like to look at total revenues from a company perspective, right, in each country. So you take all the companies, total revenues, you divide it by global. And if you do that, also China would land between 18 and 20%, right? And then emerging markets would land between 35 and 40%. The US is lower, right? More like 28 to 32%. So that also another indicator tells you that China and emerging market are not 3 and 11%, should be higher than that. So there are multiple ways you can look at it, but GDP weighted is a good direction, and then you take into consideration your risk and return perspective, risk and return appetite, and what helps you sleep at night, of course, and then you kind of find somewhere in between.
Interesting. Through our experience, we've seen a lot of investors that were excited about China because of how well it was doing at one point in time. But those same profile of investors are now interested in India, and you see a lot of chatter about India because India has been doing well. So how do you, or how would you comment on the new interest in India now that it's become that economic darling and the markets have been doing well versus China? So how do you take that allocation when I am allocating to emerging markets? Is it a factor of just GDP or all country weighted, or do I take an overexposure or underexposure based on the fact that one is cheaper or one has more momentum going for its favor? So India being the one that has more momentum, while China being the one that's lost favor.
No, exactly. So what we discussed earlier was your strategic allocation. So but that basically what guides you strategically for long term. But at different times, you're going to have some anomalies in the market which you want to try and benefit from, or your advisor is going to want to try and benefit from. And this is based on on valuation, positioning, growth, cycles, etc., interest rates, cost of capital, taking all these into consideration. You want to tactically overweight, underweight areas, that you are optimistic about or bearish about, right, in the future, based on your estimation. Investors always like to compare countries to economies to other economies, right? And like first, when China's going down, oh, Japanification, or China is the new Japan, or now India is going up, or India is the new China.
Yeah.
All these countries are very different in many ways, right? You have different political regimes, you have different, framework for economy, different industries that are more productive than others, etc. For instance, India is amazing at technology, exporting, etc. China more at manufacturing, and Japan is more at services or electronics, etc. Plus, you have different regimes, right? In India, it's a democratic system that could have some bureaucracy, which could slow down the economy. But over the past, since 2013, since the election of Modi, this has been really tailwind for India. Whereas China, it's more of a command economy, right? So basically, it's top down. In Japan, when you've had a lot of, it's a democratic economy with a lot of prime minister changes over time. So basically, these are different economies, right? We should not really compare. But the fact is, India now has the momentum, right? And it's been since 2013, we've seen impressive growth, high quality growth in India. That's transformative growth, what we call, right? So basically, this is something that could last long term unless something happens to stop it. But China is not India, right? Or India is not China. India is 2 trillion GDP. China is 15 trillion GDP. Population difference is 1.4 billion for both, but India's a lot younger. China's much more older. And in China, you have different drivers within the economy than India. I think you should have both in your portfolio for sure. But China is a much more advanced stage than India, right? And India is more vulnerable to setbacks. So you have to take that into consideration. But there's growth in both sides, arguably, more in India. And there are really, really great stories in both countries.
Nice. And with the U.S. elections coming up, and of course, it was already dominating the news, and I'm sure it's only going to be more and more impactful on news, at least news cycles. How impactful do you think that is on actual markets internationally when it comes to changes in U.S. leadership?
It could be very impactful, right? And we've seen that effect with Donald Trump in 2018, especially on China and emerging markets. And even on some industries in Europe, right, where we've seen tariffs on steel and other products. So it depends who's going to be elected, right? With the Democrats, I think the range is more narrow, and you could expect, you know what to expect in terms of how they're going to deal with foreign countries, except for China. China is more of a different black box now. Not a black box, but it's much more difficult to predict. It depends on what's happening globally and also like what the negotiations are, because now they're indirect negotiations in a way, at least with actions for the past 2-3 years. With Donald Trump, I don't think you know what you're gonna get, right? Like it could be difficult to predict. I mean, a lot of people think he's going to be more transactional in his last term, where he's going to try to curry favors with China and Europe, but you never know what you're going to get. So, but both will have an impact. Donald Trump will have a bigger impact depending on which way he's going to go.
Okay, interesting. And to move on to funner topics, AI and automation. So on one side, an argument is made that causes a lot of redundancies and lesser jobs on the short term, cost cutting and saving. But on the other side of that story, there's cost savings and higher corporate margins. So on the aggregate, how impactful do you think AI and automation is on equity market?
Oh, AI is going to be transformative. You know, it's already happening. It's gonna be amazing to see the level of productivity and change that is going to happen over the next, 10 to 20 years, right? As we incorporate AI everywhere, right? So that's going to have a big impact, on companies, on their productivity, on growth. I mean, it's hard to predict over long term. I think it's going to be positive for humanity as well. I'm always reminded by something when people hate change, right? And when we see something like this, we're like, oh my God, how is that going to impact us? And I'm always reminded by back in the days in the 1960s, actually professors and university academic people protested against the calculator, when it first came out. Literally they were holding signs like calculator is gonna kill smartness or whatever. So and today we all use it. It's fine. It was great. It's actually helped us a lot in our jobs and our daily lives. So I think AI is gonna be that way. It's gonna make companies more productive. It's gonna make us more productive, and we're probably gonna move on to new things that we haven't discovered yet. Like we'll probably, I don't know. We'll see what industries these trends will create.
Yeah, the Excel sheet didn't replace the accountants, that's for sure.
Exactly. So that's another example.
You've moved into the region, and
Yes.
over the past 4 years, you've come in often. So you've seen the how it works in America when it comes to client advisor relationships, and how the investment industry works in the US when it comes to whether it's high net worth individuals, ultra high net worth, or endowment funds, or whatever that may be. And you've seen it in the region. How different do you think it is in the UAE, in the wider region of GCC, in comparison to the US?
Yeah, no, it's a little bit different, right? And but not necessarily good or bad. It's just different. The U.S. is definitely much more developed in that regard, right? And not just on the industry level, but also on the people level. Everybody saves there, and everybody have 401ks that go into the market. 80% of the market's money is from regular people, right? Which is here, it's probably 80% from institutions or government-led institutions. So the level of savings and like sophistication in terms of wealth creation and wealth management is advanced in the U.S., right? And that's very helpful. So that helped create a huge industry, right? Like we're talking millions of advisors, right? That driven by banks, major banks, what we call the wirehouses there, which is the Morgan Stanleys, the UBS, is the JP Morgans, that have literally like millions of advisors all around the country advising people on how to manage their money. Here, it's much more driven by family offices. The retail investor is not investing meaningfully yet here. But I think with the changes that we're seeing in the region, with people moving here, with the development of the financial industry, I think that's going to happen more and more with people like you and Volt literally advancing that industry, making it more safe, making it more efficient. That's going to help a lot. That's going to attract a lot of people to want to invest here in the same time zone and dirham in the same currency, right? And they want to speak with their advisor, who's in the same country. Anytime they need something, they can call him and make sure they're well informed about their portfolio, about their wealth. So I think that's happening here, and that's one of the reasons why I got really excited about the region. Especially with regards to ETFs, where it's still ETFs today in the region are still not as prevalent as you see them in other regions. Actually, nowhere near. If you look at the U.S., Europe, or Asia, you have over 3,000 ETFs listed with massive assets in them. 1 trillion, I think, almost 1 trillion in Asia, and you go up to 9 trillion in the U.S., which is the biggest market. You look here, you only have 22 ETFs with less than 1 billion assets, right? So that's not normal, right? And there are reasons behind that, which we're trying to solve actually. And so that's one way of also advancing the wealth management industry here, of like developing the capital markets, providing the tools that investors need to be able to diversify and be liquid and invest successfully. Now a lot of the banks are investing people's money in Europe or the US because this is not available here.
Yep.
And I think once you resolve that issue, a lot of this money will come here, and you'll create more positive energy, more momentum, bigger, just more excitement about the local markets, and you'll see a lot more participation happen over time.
For sure. Getting access to diversified investments through your own markets, through your own infrastructure does make a difference.
Very
Changing of the culture makes a difference, that education element of investing. We've done the numbers a lot, and we've seen that the affluent and high net worth space, which are so instrumental in places in the developed world, of course, like the US, here they tend to hold a lot of cash. So you're talking about in financial wealth, you're talking about amounts of more than 70 to 80% allocation towards cash.
Wow.
Because they see private businesses and real estate, the more illiquid stuff, as their way of wealth management. So why is holding a large amount of cash not a good wealth management strategy on the long term?
Yeah, of course, because cash is not a very productive asset class, right? It's should be used for liquidity, for maybe protection, but even with protection, as we spoke earlier, without dollar cost averaging and market timing, being very hard, it's really going to be hard to grow your wealth, right? And wealth creation is very important for any economy. It does a lot of great jobs. One of them is it takes the money or your savings and invests it into the economy, and makes the economy more productive, provide jobs, create wealth. And then same thing is, as you're creating your wealth, when you retire, you have enough money for yourself to be able to live, and you lower the cost on governments to be able to support its citizens. So it has a lot of great function. It's an essential function in today's world, especially with the massive populations globally. We're talking about 7-8 billion. You have to go that way, right? So having it in cash kind of defies that purpose, and puts your assets in an unproductive asset class. I mean, basically, or you give it to the government, to invest it on your behalf, or to spend it on your behalf, instead of giving it to companies who can do more good with it. But here they love income as well, right? Which I think
there's a big income bias.
Yeah,
I think it's a byproduct of there's no income tax, right?
Yeah.
So you're gonna have. I think generally humans have an income bias because I say humans, us humans, we have an income bias because you get to see the earnings, so you feel they're more tangible. A lot of people say, oh, real estate is just more tangible. It's brick and mortar. But I don't think it's the real estate that's tangible. It's the fact that I get a consistent stream of income that just makes it seem more tangible. Because equities are tangible too. I own real companies that have real employees, that have inventory, that have everything. But generating that income makes me feel like, okay, I have that regular stream of income, regardless of the price moving up or down. I'm getting a stream of income. So I don't need to look at the price.
Yeah.
How many people look at how much their real estate is worth on a daily basis? Very little. And here you don't pay an income tax, which would usually stop you from doing so in the US.
Yeah. No, that's very important. Tax regulations, which helps a lot into diverting funds, at least in the US, to companies, and people want to generate their money through capital gains rather than income. Plus, also, I think in real estate, it's helpful to look at the structure, and the bigger the structure, you feel wealthier, right?
Yeah.
It's right there in front of you until something bad happens, a crash or something, and you're really stuck in real estate through crash. You just have to stay there for many years. That's why you need to diversify, right? It's good to have real estate. It's essential to have equities. Essential to have some cash and fixed income, and go global. Just going back to the diversification concept that we talked about, it's very important. But definitely, the government and the regulators and the markets have to work, and the companies and the investors have to work together to find a system that actually is able to direct flows to productive, allocate flows to productive areas of the economy while having the investors protected, right? From any crashes or crises.
So I've seen what's happened a lot between advisor-client relationships is because there is an income bias. You have the more likelihood of that advisor-client relationship ending up being with income funds. And sometimes that income funds, when it means investing in equities, it means giving favorability to dividend-paying companies. And they've missed out, therefore, on the companies that have done the best, which are growth companies, companies that don't necessarily pay a dividend because they're doing very well and they don't need to, or they don't need to pay a high dividend. So when there is an income bias, and you work on the asset management side, which is very relevant to this question. So when you do have an income bias in the country, how do you shift that income bias to at least get the client to have exposure to not just dividend-paying equities or not just high-yield bonds, but to a total return approach?
Yeah, I think so. It takes time, right? Sometimes it takes a crisis, unfortunately, to be able to do that, or it takes a really good time, like a bull market, where people see themselves behind other peers who are actually invested in equities. And this is really the role of companies like you and other robo advisors around, and also advisors to kind of educate people, to show them historical examples of how the market behaved in the past and how assets fluctuated, especially within crises, and show different scenarios, right? So it takes education, it takes time, and sometimes it takes a bull market or a crisis to kind of have people realize, that we need to be diversified, or at least let's let the advisor do his job. Instead of calling him every day that, hey, Apple's going up or whatever is going down, get me in, get me out. You just have to let the advisor, trust the advisor to do the right thing for you, and have a long-term game. And if you want to play around with some money, that's fine. You can always take 10-15% of your money and put it in a brokerage account, or do whatever you want with it. But the majority of your wealth should be long-term in a strategic allocation, through an advisor, through a temp, so you're protected, right? Because it's not a joke, because when you hit retirement, you will definitely feel, the weight of the decisions you took, before, whether positive or negative.
So I'm a big fan of, I'm a big believer in having an advisor, a human advisor. I think the research that I've seen that has convinced me a lot above my own experience has been behavioral coaching and helping clients through up markets, down markets, being there with clients and helping them through that process. So in selecting an advisor, how do we help clients, or how would you explain to someone how to choose the right advisor? What are you looking out for in terms of traits when choosing an advisor?
It's not an easy task to do, right? And you can either go to the big institutions, right? Like in the U.S., you go to Morgan Stanley, you know that these advisors are backed by Morgan Stanley. They have a framework, they have a reputation. Or you can go to a small, but you're going to get charged more or less, but you're going to get less attention, and you're going to have less input or less connectivity probably. Or you want to go to a smaller firm where it could give you a little more attention, but it's going to charge you more, and you get attention for that. So it depends on what's your preference, right? And basically, it's a gut feeling too when you speak with someone, and just you kind of feel it's the right fit. And make sure as you're going through the process, you're comfortable with the way they're onboarding you, they're assessing your risks, they're listening to you based on what are your requirements, and they're not just trying to tell you what to do, but actually meet your needs, right? Like if you have a specific amount of assets, you want to buy a home in 3 years, they should be putting you in investments that that are liquid, right? So you're able to meet what you're looking for. And then just advising you, right? Like also as well, sometimes they have to tell you if they don't agree with you because of specific aspects of your, maybe you have high expectations or whatever. So it's not an easy task, and once you get an advisor, should be for long term. Some people do 2-3 advisors first, and then they end up choosing one. But yeah, it's a very important process, and everybody should seek to do it. Even investment professionals, behavioral finance is massive. It's huge. It's real, right? Like, you've seen the market go up and down so many times, but yet every time it goes down, you just, you can't help but feel the stress, and which could lead you to do things that you shouldn't do. So let somebody else deal with that, right?
So as an industry, that was going to be one of the questions. As an industry professional, how different is investing from from a personal level of your own wealth versus giving guidance to others?
Yeah, no, it is different. It's different in a way. I mean, we definitely are more informed, right? We've seen a lot of examples. We've seen a lot of test cases, and we follow the markets. So we're definitely more informed, are able to make decisions, but we cannot be specialists in every single asset class, right? And so you may know one or two asset classes, maybe three, and you definitely not going to know all the companies, right? Some people I speak with sometimes with advisors who are following like 150 companies. I'm like, how do you have time to do all that? Like 20, 30 companies is a huge workload for any analyst. So basically, you need to have someone help you with that, right? Who's backed by a system, who's backed by major research organization, or have the capabilities and be able to monitor that on your behalf on a daily basis, and put you in places that are strategic long term. So yeah, it's we're well informed, but I don't think we're able to manage our wealth or long term wealth without the help of somebody.
And another question relevant to the region, which is the average profile of a household in the region would be someone who is either saving towards financial independence. I think especially in an expat-dominated market like the UAE, people tend to come here to save, at least for a future goal. Now, when they come here, expenses rack up, etc. Maybe they don't do as well. But the intention is to save towards being financially independent in the future. Or it is people who already have a large sum of wealth and they want to achieve financial independence by getting an income from these assets. So what do you think a reasonable portfolio looks like for such individuals, in terms of potentially bonds, equities, real estate, alternatives? How would you see a reasonable portfolio look like for such?
Yeah, no, you have to be well diversified, right? But then it depends on what's your starting asset level, right? So if you're starting with 10, 20, 30K, you want to, S&P 500, and some of these major indices like the AG or MSCIM or even KWEB, for China, so you're more index level investing. But then when your asset is growing more, then you're gonna want to get more granular. You're gonna want to get more deeper. You want to diversify. You want to invest in themes, potentially electric vehicles, carbon, robotics, AI, etc. And that definitely these options are available with your investors, right? Because they're evaluating these type of investment opportunities on a daily basis. Even you guys, when we spoke, you mentioned, you showed me the side where you have the optional, but then the thematic ETFs that you include, which you change every now and then. So these are important aspects for your portfolio that helps you get an edge in generating alpha, and also provides you with correlations, because these long-term themes tend to have less correlations with global markets unless you have a crisis, right? Because they have much higher growth. Their cost of capital is lower because people want to invest in them, for many other reasons. So it's depending on your asset level, you have to be diversified, and there's a lot of tools today in the market through ETFs to be able to pick and choose where you want to be. But also, again, you want to be helped with someone.
Okay. And we talked about thematic just now. And so what do you think is the most exciting places thematically right now?
AI, for sure. I think it's probably the big, most exciting thematic place today because of, I mean, when you speak about thematic, it's mainly long-term growth, right? It's transformative. It's overhauling whatever we're doing today into something new, right? Changing our way of life. And that's why I've been excited about electric vehicles, right? Because this is something that is going to change our lives, right? We've been used to ICE vehicles or internal combustion engines for 100 years now, and we have close to billion plus cars on the road today that we need to get rid of in the next 30, 40 years, and replace with, as of today, electric vehicles is the leading choice. So that's a huge investment opportunity. That's AI is even bigger than that, right? You're talking about like changing industries across the board, and using AI for these companies to become more productive. And there's a huge incentive to do it because that lowers your cost and makes you more productive. And so people are going to demand it too. Your customers are going to demand more sophistication, more power behind your offerings, and AI can provide that. And in order to get to that level, we're going to have to produce a lot of chips, and we're going to have to, there's a lot of coding and a lot of software generation, all these things, development, and these are massive. You're going to need a lot of servers, a lot of memory chips, etc. These are huge investment opportunities. So AI is probably number one, and then the climate change is right behind it.
Very nice. And on a more broad level, why do we save, and what is the purpose of wealth?
Yeah, like I said, wealth is very important. Wealth creation is very important, right? It serves a lot of functions in our society. First, it makes our economy more productive. It makes our companies more productive as they have access to capital. And then it helps us when we retire, right? And the worst thing is retiring shorthanded, having to need funds from somebody else. So wealth is very important. It's a big decision that people have to deal with on a daily basis. Even as young as they can be, the better, the better the results in the long term. So yeah, it's very important.
So what we've seen a lot in modern media is the emergence of ETFs, and now how a lot of investors associate ETFs with passive. So we associate ETFs with S&P 500 and passive, not realizing that ETF is just an investment vehicle that could also be active, could be thematic, and there's so many different variations of how you could use this vehicle. So can you tell us, or can you tell the listeners more about what are ETFs, and probably try to deconstruct this element of association between passive and ETF and S&P 500 together?
Yeah, passive versus active. This is so 2010.
Yeah.
And you're getting older by using 2010 reference instead of 1999.
Yeah. I think you've been used to the US too often as well.
Yeah. So, ETFs, if you go back in last 20, 30 years, it's really one of the most impressive financial innovations we've seen, right, come out in the financial services industry. And the reason behind that, it's because it was able to provide investors and advisors with a tool, right, that can be very targeted, that can be cheap, that is transparent because you're seeing holdings and movements on a daily basis, and there's very liquid, right? Before we used to have mutual funds, which are the same concept in a way, but mutual funds trade once a day at 4 p.m. at close, right, where you match orders, and and has hefty fees, right, 1.5, 1.6% sometimes. If you want to get out early before 2 years, they charge you an additional 5%, or when you get in, they charge you 5%. So ETFs simplified all that, right? It allowed investors to have access to these tools, and also allowed issuers or asset managers to provide investors with very targeted allocations, like EVs, like robotics. Now the biggest trend is weight loss, with the weight loss ETF. So you can just create an ETF out of anything you want. You just create a bunch of companies, and you put them in a fund called an ETF. So it's an exchange traded fund. So basically, the ETF married the concept of a mutual fund and a stock, and then the offspring is an ETF. That's why we believe it's a huge investment innovation in the financial services industry. And this industry has seen amazing growth. So basically, it started in 1993, usually through State Street, where they were able to create SPY, which is now, today, it's $250 billion ETF. It's massive. They kind of through the creation and redemption baskets. So there's a specific framework for ETFs to work, right? So you have brokers creating the baskets and redeeming the baskets on a daily basis, where this basket would create a unit of ETF share, which would trade, and investors can buy and sell instantly in the market. And then you created behind that a framework, an infrastructure of market makers and liquidity providers who are willing to take that order from you at any instance. The second you push a button, there's someone always on the other side taking that order from you or selling to you. So today ETFs are close to 13 trillion in assets, which is amazing, right? They're more than 30% of the trading volume in the New York Stock Exchange or in the U.S. There's more than 3,000 ETFs listed in Asia, in Europe, and in the U.S. It's seen massive growth. Still not in the GCC, hopefully soon, but a lot of the GCC investors are invested in ETFs in different regions. ETFs used to be perceived as passive, and rightly so back in the days, in 2010, because they used to follow a specific index, usually in S&P 500, an ACWI, a global bond, etc. And back in that period as well, we saw a race in prices to the downside, where Vanguard came in and was able to offer these tools for like 5 basis points, and then you had BlackRock as well. So that created a whole new breed of ETFs, because other issuers were like, okay, what are we going to do here? We can't compete with Vanguard, we can't compete with BlackRock. Let's try and do thematic stuff that is more niche, more specialized, and we can charge more basis points. And this is where you start seeing the creation of thematic ETFs. But then it took a whole new level, because that was so successful and so helpful for investors, that now you have actually an ETF for anything, right, as I mentioned. And that helps you target something very specific that before you were not able to do. Before that, you needed to go into a mutual fund, invest with a portfolio manager, and it was up to him to put you in these specific themes or not, based on his view. Today, you don't need a portfolio manager. You can do it yourself just by the ETF. And now we're seeing that evolve even more. Today, like, we're seeing ETFs based on derivatives, like cover calls. So at KraneShares, we launched recently CLIP, which is a cover call strategy on KWeb, basically making the volatility of KWeb work for you. By buying these front-end calls or selling these front-end calls, you can generate a very healthy premium, which you can distribute to investors on a monthly basis. And we've seen that also very successful. JP Morgan has a US market one, S&P 500. So now we're seeing ETFs go into derivatives and buffer ETFs, where you have a limited downside. They call it defined outcomes, and we're still innovating. So that's why ETFs are really changing the way we invest today.
And I think I would be interested to see how this was resolved in the US. But what you see a lot is with mutual funds that charge 1.5%. The fund manager pays the distributor being the advisor, half that fee. So essentially, if the mutual fund has a fee of 1.5%, half of that goes towards the distributing advisor, 0.75%, and that's shared. And when you have an ETF that charges 0.25 or 0.5%, and it's not being shared with the distributor, the advisor now doesn't have an incentive to position the ETF. So in the US, unlike other places, you see the emergence of ETFs and even advisors adopting ETFs. So what happened in the US in particular to move advisors away from mutual funds and getting paid from the fund manager of the product to now being able to provide ETFs and still generate a healthy business in that way?
Yeah, that's a great question. And that's very even relevant for the region, right? And some of the areas too where that still works, where an advisor gets what you call it, sometimes you call it kickback or whatever, from asset managers.
Kickbacks is a dirty name. Yeah.
Yeah, and it is. I don't want to call it, but this is. I think it's a conflict of interest, in my opinion, right?
Definitely.
So basically, because you want investors to be placing you in funds that are beneficial to you, rather than funds that are beneficial to the advisor, right? From a monetary perspective. So in the U.S., this is all banned, right? Kickbacks are banned.
Really?
You can't do kickbacks. You can do revenue sharing with the big banks, right? Like Morgan Stanley, UBS, the warehouses. where you do revenue sharing, and they have to take any fund, whether it's 2% or it's 5 bips, and then the advisor would place you. The advisor will get nothing by placing you in these different products. The bank will get that revenue share. But if you have other wealth managers like registered investment advisors, which area you call area here, is it called external asset
Independent
manager or
financial advisors or
independent
external
something?
asset
Yeah.
managers, correct?
Right. Or if you're an institution, you're definitely not getting any kickbacks. So that kind of help level the playing field, right? And this is why you start seeing a lot more money goes into ETFs. These rules are not in effect here yet, right? And this is one thing I think, in my opinion, should happen, right? Because of the conflict of interest.
Makes sense. I think it makes it even more important than when you're dealing with 2 to 3 advisors, or you're meeting 2 to 3 advisors. Understanding how they get incentivized as well becomes very important in terms of assessing the conflict of interest side of things.
Absolutely.
And I think to the point you've already made, which is the infrastructure here is being built. As we have the infrastructure, more and more infrastructure, we're adopting the more developed market standards when it comes to that. So we are moving forward, but it seems like we have more to go.
Yeah, absolutely. I mean, it's still the market's not as developed yet in terms of the infrastructure. I think the exchanges are doing a phenomenal job in terms of like trying to advance and providing investors with different ways to access the markets, even private markets today. In some ways, actually, the exchanges here are more advanced than global exchanges.
Very nice.
And in some ways, there's still work to be done, right? And one of the big things for ETFs, as I mentioned, in order for that to work, every time you put an order in, someone has to be on the other side to take that order from you. That's called market maker or liquidity provider, and that's still that's still not available for, at least for international markets, or market makers are not very much incentivized to do ETFs yet because the demand is still low, and it's a chicken and the egg story here, right? If you don't have an ETF, then demand is low, but if if demand is low, then no one is incentivized to work on these ETFs. So you have to bring the chicken one way or another, and I think that chicken will have an egg at some point.
For sure. You have to bring up the supply and then
Yeah.
have confidence that the demand exists. It's just waiting to be bloomed.
Yeah, and you just have to have the confidence that in the long term this is going to happen. And it's not really rocket science, in my opinion, because like we've seen this happen in every region, and there's a lot of wealth here in the GCC invested in ETFs from banks. I speak with banks, speak with family offices, or even with institutions. If you speak with institutions, even in the U.S., like 5-10 years ago, they would say no ETFs, right? Because they were index passive, and they made their money actually from analyzing investors or analyzing asset managers and funds, and which we call due diligence. Today, the business model is shifting towards more asset allocation.
Yeah.
So they're taking these tools and allocating on your behalf. So you need this infrastructure to be in place to be able to help ETFs grow in the region. And I have no doubt, once this infrastructure is in place, there's no reason why ETF should not be as successful in the region.
At the end of the day, it's a logic, right? You own a fund. It's exchange traded, just makes it simple, right? But at the end of the day, you have ownership in a fund, and you therefore own whatever is underlying within it. And if the underlying represents something I want to own, which is diversified ownership or diversified lending, I own this fund, and it's being exchange traded is a benefit. It's ability to liquidate, it's ability to buy, to sell, not needing to do it once a day, doing it at my own comfort, doing it in a low-cost structure that allows me to benefit. It's clear as day as why that would be a need to have into the market.
100%. I can't even imagine, back in the days how, trading funds was once a day. One thing in the U.S. that is actually really helping the mutual fund industry is the 401k plans. They still have to be invested in mutual funds.
Oh, still. And 401k is what's the retirement equivalent
It's
account,
the
right?
retirement equivalent, right? So it's the plan that as an employee you contribute to with every paycheck, tax-free, and then the employer tend to match that. So there's a huge incentive for you to save, and those savings go into funds. Now 100% are mutual funds. ETFs are not really admitted yet. You can thank the lobbyist for that, I think. And I think, despite all this, we're seeing the mutual fund industry go down, the ETF industry actually grow massively. And once you have you will have a change role in the 401k plans where they can invest in ETFs. I think that's going to be probably the end of mutual funds.
Yeah. And then the whole world usually follows when it comes to these kind of things, by seeing that trend.
Yeah.
And last question, looking back on your journey and the insights you've shared today, what would you say is the most important lesson for our listeners?
Well, I'm still midway in my journey.
Young guy.
Maybe if we meet again in 20 years, I'll give you a better answer. But I like two things that I try actually to pass on to my kids. Although it can be really annoying to have these two features in your kids when they're young, but I think it serves them well in the long term. One is curiosity, right? Wanting to, being very curious and wanting to know about everything and flip every chair and look under every carpet and do all these things for the kids. And two, persistence. They don't take no for an answer. Yeah. So these are two things that really help in the long term, I think. And sometimes results may not come quickly, but I think curiosity and persistence pay off for the long term.
I love that. That's a great note to end on. Thank you so much, Anthony.
Thank you for having me.